Welcome to Wealth Beyond the White Coat, a show where we dive deep into the world of financial freedom for dentists and medical professionals. I'm your host, Deren Flesher, a dentist with a passion for uncovering the strategies that lead to a prosperous life beyond the office. Every episode will explore the avenues of alternative investing, tax mitigation, and secrets to build wealth that the textbooks don't teach you. Whether you're looking to enhance your financial literacy, discover new investment opportunities, or simply find a better way to manage your money, this is the place where your financial health is the core of our conversations. Welcome to Wealth Beyond the White Coat, where your journey to financial clarity and freedom begins. Welcome back to Wealth Beyond the White Coat. I'm your host, Deren Flesher, and just want to thank you for joining us again. In part one of our conversation with Rob Woomer from Skyway Capital Markets, we delved into the critical role of managing broker-dealers, the intricacies of capital raising, and the importance of having skin in the game for sponsors. We also discussed the evolution from country club money to institutional investments and the significance of having robust investor relations. Rob also shared invaluable insights on the importance of strategy, alignment, and the human element in investment decisions. We explored the challenges and opportunities that arise in real estate, especially during unforeseen events like COVID, and how good sponsors navigate these turbulent times to protect the investor capital. Today, on part two, we continue our conversation with Rob, diving deeper into the nuances of underwriting, the significance of scalability in investment strategies, and the critical role of third-party due diligence in ensuring investor protection. We will also discuss the delicate balance between size and performance in investment funds and the pivotal role of trust in investor relations. So let's jump back in as we continue to uncover more secrets to building wealth beyond the office.
We could talk a little bit about that because I would like to look, because one of the other things is being a guy that's on the front line of this, like doing this all the time. I know who the relationships are, like yourself in the managing broker dealer space, that are looking for good products, good people, that you can create good products, that you can structure it in a way that ultimately an investor that this is unknown to would want to ultimately invest in it when they saw the way it was packaged up in a best in class way. But then the colder, more callous third party firms that would look at something and try to poke holes in it, or just another set of eyeballs, right? Hey, maybe you guys got rose colored glasses because you like these people so much. And when you were trying to put together the deals, are you really sure you're seeing it the way it looks? So then, like, some of the things that I've done is I'll go look at a deal, and one of the ways you look at it from an investor protection standpoint is, what is this deal supposed to do from an economic standpoint? Is it supposed to be a debt deal and have an 8% distribution or something on it? I will say, wait a minute, do I have any other private credit offerings that I can get an 8% distribution or a 10% distribution or a 12% distribution or whatever it is, right? And then there's the duration. Is it a 2-year, 3-year, 4-year? How long are we holding it? And I'll say, against its peer group, I have 10 other things that do the exact same thing from a outcome standpoint. So then I'm like, do I need another thing to solve that problem to further diversify? So maybe I do need another thing to do that to further diversify. Do I trust and understand this thing that financially creates the exact same outcome as other tools that I already have? If I like it and I want to add it as a diversification tool, great. But if I just don't understand it, and I know when I try to explain to a client what they're doing, how they're monetizing, and how they're turning $1 into $2 or an income stream compared to the other ones, it's a harder story to tell because of the complexity of the asset or where this knowledge base came from or something. Like, I have shut deals down before, just like I don't want to educate anybody on that. It's just way too complicated of a story, and they're never going to understand it. There's going to be way too many additional questions. It's just, there's an easier way to get that same financial outcome. Like, when you guys are looking at deals, that's one of the things that I find is a way for me to easily exclude deals if I don't want to make somebody's life overly financially complex. How much of that thought of, will the investor connect with this? Will they understand it? Or is this just over their head for the most part? And we're going to have to tell them it's a good thing and they're going to have to trust us.
Yeah, and there are strategies that are more complex. Most people do understand real estate at some level, but they don't necessarily understand the oil and gas business, which we're bullish on that sector as well. But people are smart. And if you spend time educating them, simplify it. Sometimes you got to simplify it. Sometimes you don't. I was last year raising capital for this one client, and I had an advisor set up a call with one of his clients. The guy had more questions than the advisor could answer. And it turned out that the client that he had used to run a division of Harvard's endowment. The guy was probably the smartest guy I've ever had the pleasure of talking to. He was a little too smart for his own good because he got in the weeds and things that, in my opinion, didn't matter on the underwriting. If you think about it, underwriting is trying to predict the future. The only thing that's 100% sure in any underwriting is that whatever you think is going to happen, it's not going to happen exactly that way. So this guy wanted to figure out exactly what's going to happen in year 5. I was like, okay, I'll help you, but you're missing some things. But if we simplify things and make it, okay, here's the core of that investment. And yes, it's complex. Everybody's business is complex. I've developed real estate in the past. It's unbelievable how much goes into it, how much changes over the course of 6, 7, 8, 9 months, and how nimble you've got to be, and the paperwork you've got to do, and all the different things that just keep changing and moving. And there's a lot of complexity, but you can simplify it. I'm building apartments and I'm building them on this corner because of this. Here's the renter base, and this is why they're going to come to us. And this is what the product's going to look like. I just simplified it. Everybody can understand that. To try to understand exactly how to develop an apartment, if you want to go down that rabbit hole, you'll never make an investment in a development deal. It's just way too complex. Simplifying is important. We want to make sure that everybody's got as much information, as educated as they want to be. But at the end of the day, no one's going to be as educated as the guys actually executing the strategy. And there's always going to be, at some level, there's some need for trust in you guys, trust in Skyway, trust in that sponsor.
Matt,
Sure.
talk a little bit about we talk about betting on the jockey and the people. And you had an experience a few years ago where you were doing a due diligence visit and then you guys went to dinner afterwards. And talk about how that dinner was very impactful in your opinion on that sponsor.
Sure. And I want to pivot back to underwriting on that because we were talking about before, but yeah, I can share that. So there was a deal that was circulating our industry. It's funny. I was having a conversation about this just last week. People ask me about this deal all the time, and they were new to our space. Supposedly we're doing the right thing in the right way. There was a buzz about them. It was a roll-up strategy where you buy a bunch of different companies, create aggregation value at a larger level, and ultimately try to exit and sell those businesses. And things I've learned over the years. First of all, these guys were the first time coming in the space. And Rob, you can speak to this a little bit, but they were raising over $1 billion for the first offering. And I'm a fan, and what I've learned from guys much, much older than me were like, because when I first started doing this years ago, I would go to the conferences where the attorneys and all the due diligence type people were, and I would find the oldest guy in the room and say, can I buy you a glass of wine and tell me what I'm missing? Because all of this sounds really darn good. What am I? And so some of the stuff that you learn are have somebody come in the space and do it and execute with $50 million. Have somebody come and execute with $100 million and then raise a second fund and do it again and continue to grow and be patient and do it over a 10-year period. When somebody comes out of the gate and there's no proof at scale that they can execute with $1 billion of capital, that's something in and of itself that should raise a little bit of a red flag. They were already on the radar for me of too much money too soon. What are they going to do with this much money? It's hard to scale and deploy that much capital. There's tons of history of people raising too much money because you can do a thing. Warren Buffett even says, if you've got $50 million, you should be able to double your money every single year because there's enough inefficiencies and opportunity in the market to double your money. But if you've got $50 billion of capital to deploy, you fundamentally have become the market, and it's going to mute your returns and hard to deploy efficiently that much money. And that happens with sponsors too. Smaller sponsors, more nimble, capable to buy these underpriced or assets, and their strategy will outperform to a certain point of scale. So number one, it felt like too big of a fund. felt like their return stream that they were promising investors that they were going to get. They were telling everybody, we can get a 20% annualized rate of return. We're going to do this for maybe 5 years. So maybe in the next 5 years, we turn $1 into $2. I knew 20 firms that were turning $1 into $2, right? That I felt like I felt more comfortable with and understood their underlying strategy. So then I go to due diligence and I'm meeting with the human capital and we're sitting there talking. And I walk out and I'm with like one of the executives of the firm after I'd been there all day interviewing the CEO, the CMO, all their people, all the technical people. And the guy flips me the keys to his car and he says, hey, I'll bet you $1,000 you can't start my car. Now, it happened to be an Aston Martin. I happen to have clients that have Aston Martins. And this particular model has this little nuance where it doesn't have a place where you would insert the key. But if you hover the key over the dashboard in a certain place, car would open up, you could insert it or whatever. And it was a fancy thing for a fancy car. That's a douchey thing to do. And I knew how that mechanism on that car works. So I played, I'm from the South. So anytime these Northeastern guys are around me, they think I'm a dumb Southerner anyway. So I play into it and I okie dokied him a little bit before I happened to hover it over the right place and knew how to start the car. Right. And he was, oh, you got lucky. And I was like, oh yeah, I got lucky. No big deal. But that was I don't know. For somebody who's trying to raise money for you, it just felt a little off, showing me he's got a fancy car and then bet me on something dumb like that or wanting to bet me or whatever. That was start. So the radar goes up, but then we go to dinner. We end up going to a 5-star steakhouse, which is a common thing in this business. You're talking about guys that make a lot of money for the most part. They like to eat at high-end steakhouses or whatever. And I expected to go in there and there to be me and maybe 3 other people that I had talked to throughout the course of the day, because a very typical conversation on the back end of that is, hey, what did you think about your experience today? Who did you have some great conversations with? Did you have any questions that ultimately weren't answered? And what's it going to take for us to support you to help you educate your investors to find out if this is the right opportunity for a piece of their portfolio? And so I walk into this restaurant where there should have been a 4-top with 3 of us at it and myself, and there's 25 people there. All of them are corporate type tops from the group. I'm the only person doing due diligence there. And this is at a steakhouse where you're talking a couple of $100 minimum a person to be able to sit down and have dinner. And there's wine on the table and bourbon on the table and steak and lobster. And they're spending investor capital recklessly at this point. And I'm just like, there is no chance I am raising money and giving these people money because they think every dollar that comes in is their dollar, which the reality of it is a sponsor relationship is the dollars are on the back of the deals after you execute when you're splitting profits with your investors. They're not on the front when you're raising a bunch of capital, right? And it just so happened to turn out that that group, once they raised enough money real fast, I think they got in a lot of scrutiny for buying a private jet with investor dollars that they shouldn't have done. I never put $1 in that deal. I never put $1 in it. And I know who I'm talking about when I talk about it, but a lot of people put a lot of dollars in that deal and got snowed under on that deal. And it's caused and lost a lot of money in that through the process. So that whole looking at firms like yours, but then going and having my own experiences in it from my perspective to go, do I really even want to talk to these people? And if something goes bad and I have to make a phone call, am I going to trust what they tell me on the other end? They didn't pass that radar and that sniff test for me.
Right. And a lot of things in that, a lot to unpack there. That was your radar from your years of experience saying there's something wrong with this guy. That is the diligence you do, get to know these people, and then rightly or wrongly, you trust your gut, right, on the people. But to address the size issue, so I've always looked at it, if you come to me and say, I need help aggregating capital because I've got this plan. If your plan is, I want to develop 4 apartment buildings over the next 2 years, that's a very realistic plan. And there's a certain amount of capital you might need for that, $100 to $200 million. That makes sense. So I'm going to help you raise capital that you're going to deploy into deals, some of which may be identified, some may not. And you're going to go out and you're going to do this development strategy. If somebody came to me and said, two ways to have this conversation. One, I have an opportunity to build 20 apartments in the next 2 years and I need $1 billion. Then, okay, that's fine. You've got a plan over the next 2 years. Let me see it. What does that look like? What is that to you? And that's not If you're going to deploy, again, I understand the development business as you do. If you're going to do that, you need a lot of people. You've got people in different markets, you've got teams doing stuff. There was a famous company that had a great model called Trammell Crow, and they had teams in every market. They could do that. They could build that many apartments in 2 years. But your average guy might have a hope and a dream. He's not going to be able to necessarily execute unless that's when you really got to dig in. The other thing and that's not a red flag. That's just okay, let me do the diligence on that. I have never had anybody come to me and said they want to develop that much in that short of a period of time. But if they did, then I'd go through a process. Now, I have had people come to me and said, I want to raise $1 billion in the next 2 years. And they lead with not, I have a business plan that I need to be funded. They lead with, I want to raise capital. And that's a red flag. It's not necessarily a bad thing. Maybe they just skipped over something, or maybe it's just their personality. But to me, immediately I start asking a lot more questions. Why do you want to raise the money? Why did you start with that? What's your business plan? It's just a whole different thing. And when people come with that approach, they just want to have assets under management. They just want to raise capital. And in their view, let me raise the money. I have a loose idea, most of the time, a loose idea how to deploy it. Oftentimes, there's not a lot of substance behind it. That is size can be okay. And there are plenty of businesses that are scalable. I've been talking to, or I know a firm that is a $20 billion asset management firm, and they could scale to 40 billion if they had the capital tomorrow. But they're investing in liquid securities. They're investing in what's called RMBS, which is residential mortgage-backed securities. They're doing a lot of really cool things. They could scale pretty well. A developer is going to be tougher. There are big firms out there that just say, oh, look, we're gonna have 2 billion. Our investment strategy is to allocate across asset classes. There's a lot of reasons to have that. It's not going to be sharpshooting. It's just going to be a broad allocation to a certain asset class, real estate, maybe a subsector of real estate, maybe a broad allocation to different financial companies, whatever it is. That strategy is scalable. If you're looking for kind of the highest impact investments, the ones with the most octane, usually you've got to partner up with a sharpshooter, somebody who really knows a market really well, really knows an asset class really well, and they're not necessarily scalable, but you're going to feel really good that it's going to have the best possible outcome you could have. So different ways to look at it. I think there's a place for size. I think there's a place for allocations, but I think it comes at the expense, to some extent, of total return.
Hey, I just wanted to interrupt the show real quick and tell you about an exclusive member discount for Legacy Point Group members. The company is called Gelt, and they're both tax planning and tax preparation. We connected because their CEO actually comes from a family of physicians, and he understands the financial complexities that healthcare professionals face these days. Legacy Point is honored to partner with Gelt because it's our shared mission to empower successful professionals with optimal tax and financial outcomes. For your 20% discount off financial planning and tax preparation and priority access with their onboarding, become a member over at legacypointgroup.com.
The ironic thing is size typically is associated directly with brand, right? You hear a big firm can raise a lot of capital, a big name, a BlackRock, a Blackstone, a big name can raise a lot of capital. But I think there's an inverse size premium for outperformance. Like I talked with the Warren Buffett analogy in this space, right? In the private markets is less is actually more from a return standpoint in deals, because you could find an asset or a strategy in a sub-market that you couldn't deploy 50 billion, but you can deploy 50 million and get a substantially outsized return. Let's talk about how that connects to the differences between looking at somebody coming to you with fully underwritten assets and a well-developed business plan, just now needing capital for it, versus the concept of a blind pool where they're just raising money arbitrarily on some much larger idea of a strategy, and then going, once you give us the money, we'll see if we can go and find the assets to be able to execute on, which creates a time and yield friction point when you have to do that, that then sometimes causes those blind pool funds to overpay on the acquisition of assets because they got so much cash just sitting on a balance sheet. And if they don't deploy it quicker, it creates a structural inefficiency in the way a blind pool fund actually works. Let's connect that dot.
Yeah, so that's why it's important to understand what their business plan and what it is over the next 2 years. So there's different types of blind pools. So if you take a step back and again, just focused on real estate, it's very difficult to tie up real estate without capital. So you're always going to have some component of a deal where they're trying to raise capital to execute a strategy. You're going to have some or all of that strategy be blind pool because a deal, there's a process. There's oftentimes brokers, sometimes not. We like the ones that don't have brokers involved, but there's a due diligence process and a negotiating process. And then usually from start to finish, you've got 120 days. And oftentimes that's not enough. You can't get 20 deals or 10 deals or 5 deals tied up and then go find the capital. So to have a pool means you've already had capital and you're recapitalizing it, right? You're bringing new money in to buy out the old. That creates conflicts. So you want to balance between going into existing deals. And the conflict, by the way, is I bought it here with this capital partner. Now I'm bringing you in to help recapitalize it. I still want to own it, but maybe this partner doesn't want to be there. What's the value, right? I'm a new investor. I want a good deal. I'm the old investor. I want a good deal too. That's a really tough thing to overcome. It's not insurmountable. There's lots of third parties you can engage to validate things. There's sometimes the old investor is distressed. Maybe there's some problems there. So you can actually get a good deal. So it doesn't preclude you from doing deals just if you're recapitalizing. But what we see most of the time is we've got a strategy maybe to deploy into 5 to 10 different deals. And we've got some of those lined up and we've got a track record of being able to execute. And again, we're not trying to do something that's not achievable. We've got a certain amount of deals based on our history of being able to execute X amount of deals per year. We're going to continue to do that X amount of deals per year. They look like this. This is what we've done in the past. This is what we're doing now. This is what we're doing in the future. It's a good execution for an investor to come in and look at what's already here and what are they expecting to do. Now, an early investor is going to have an opportunity to look at 1 or 2 deals. Let's just say they're trying to raise money to do 10 different transactions. So an early investor might have 1 or 2 deals to look at that they've either already closed or they're about to close, it's in process. The last investors, and typically a $100 million fund, let's call it, is going to take anywhere from 9 to 18 months to raise the capital. Those last investors, if we're doing 10 deals, they're probably going to be able to look at 7 or 8 of them. So there is some benefit at the end. There's also a benefit to be early because if you come in early, just by being invested, you make more money. But we structure deals to give early investors an incentive, maybe a little bit more ownership, maybe a little bit higher yield, different things that reward them for coming in when it is more of a blind pool, meaning I don't really know what I'm investing in. I'm investing in a strategy. I'm investing in this team. I'm investing in this fund, but I don't know exactly what the assets are. And then in the back end, you now more and more more likely what the assets are. So it's a balance. There's some people that just say, you know what, I want to be the last investor in the fund. Fine. That I get it. You're losing out. If it takes 18 months to raise capital, you're losing out on a preferred return. You're losing out on some distributions. You're losing out on potentially that early investor incentive. But on the backside, I've de-risked my investment because now I know mostly what I'm getting into. And so every investor is different. I personally like going in early because I make more money. But again, you work with clients. I think you're pretty good about explaining kind of the differences and the benefits and the risks of early and late investors. So every aspect or every deal, some aspect of blind pool, but it's up to your own mental thesis on how early you want to get in, if you want to wait, whatever it is.
You're right. It's funny when I started learning this business, one of the things that I stumbled across early from a conversation about this is you find a lot of people that do like to come in late. There's more information, you have more assets, there's already other investors in the thing. That makes people feel better at night. And because private market assets are typically illiquid, depending upon obviously the structure, right? We mostly do a lot of private partnerships, but they've started to try to create semi-liquid structures over the years that people can participate, evergreen interval fund type products, which I'm not really a fan of from a structural standpoint, because I like an executable outcome and a split of profits and then giving money back and going, do you want to do this with me again, instead of just holding it forever. But so when you come in last in a fund, also, you're going to have liquidity sooner typically, because they're closer to executing on their full cycle business strategy and selling off their assets. You have this shorter term illiquid period that is a common thing with illiquid assets and private partnerships. So agreed. But like you, the more I've learned, the longer I like to be in sooner than later. I trust the humans. I look at the people. I make sure I understand what they're doing. I feel really comfortable about their strategy. And then talking about the entry point between assets that they already own and how you connect those to a value as investors start to recapitalize what those people own. You made me think of something at that particular time. And I think a common word that most investors aren't comfortable with or familiar with is markup. Right? Like, how does somebody own something that before it got given or accreted to the fund as a contribution? What value did it go in at? Did it go in at a value where, yes, I made a reasonable profit on it for the risk and the time I've been involved in the deal and the capital I put in? But was it still put into the fund at a valuation that the investors have some meat left on the bone for them to make some money as I continue to go forward with the strategy? Or did it get marked up to such a price that I took all my chips off of the table and then some, and it makes it really hard for the future investors to make a profit? And when somebody's looking at these private deals, what experience has taught me is people look at the fees in the deal or the carry in the deal or the preferred return in the deal, and that's how they think they determine they're going to make money or not. They don't even know to ask about what was the markup of the assets when they were contributed to the partnership in the first place. That's not even a question anybody asks. And that could completely, misalign if there's an opportunity to even make any money or not. There's some really big national syndicators that market like crazy directly to investors that don't go through the financial services ecosystem, that don't disclose the markup of their assets in their fund at all, and make tens or hundreds of millions of dollars on markup alone without even hitting a profit participation split or a waterfall in their deals. And investors don't even know and think they're getting a good deal on that stuff.
Financial freedom is about making the right moves at the right time. As practice owners, we often reach a point where growth stalls. Instead of maintaining at that plateau, consider cashing in now, putting that money to work for you, letting it double, triple, or even more over the course of your career, and then go pursue more of what you love to do. This is exactly what I did with my friend JW, a dental practice broker who found the perfect partner for my practice, maximized its value, and optimized the deal terms. He offers a free valuation for those considering a sale. If you want an introduction and the same red carpet treatment shown to me by my friend JW, email me at Deren@legacypointgroup.com. That's DEREN @legacypointgroup.com. And I'll be happy to connect you with JW to start your journey to financial independence.
Yep. And so I think that if you think about the risk profile and you think about getting into an asset, whether it's something that's bought after you've made the investment, or they bought it and they're going to mark it up or transfer it to the fund or whatever they do, there is a case to be made to buy an existing asset from everything we're buying from somebody, then we hope there's meat on the bone. So your biggest risk is when you have a new asset. So a development deal where there's just a piece of dirt. You've done a lot of study around the market. You have a reasonable expectation that there's a need for that. We see the most activity in that asset class around apartments because there's a shortage of housing broadly. Single family homes, apartments, condos, there's a shortage expected over the next 5 to 7 years, mostly in the South and Southeast. But so you do your studies and you look at what's going to rent for and everything. You're taking a lot of risk because you're investing in a piece of dirt, and it takes a couple of years to build it. And then you've got to stabilize it, lease it up. And then you hope it performs what it's supposed to perform. Now, in this market, with inflation being where it's been, with the demographics putting wind in our sails, It's very hard to really screw up a deal like that, but it is riskier because things can go wrong when you're doing a development deal. But that development deal then eventually becomes a stabilized apartment, meaning it's leased up in something in 90 to 95% lease up rate. Its rents are at the market. You can't really push them very heavy. You can just go wherever inflation is going or whatever's happening in the market. And it turns into not a risky, I'm going to go from dirt to a product and try to double my money, to now it's a stable source of predictable income, and I'm going to make 7 to 10% or some number over a period of time. But what a lot of investors do when they get to that point, so some different owners have different views on things. There's a lot of short-term thinkers that say, okay, I'm going to buy that asset from the developer at some price. Now it's going to be a stabilized cash flow generating machine. And let's just say it's generating a 10% cash flow. I'm going to do everything I can to get that 10% to 11% because that's important to me. And what they do oftentimes is they don't put money into it. They let it spiral down. And what happens is, if you're not maintaining it, you're not putting the proper capital in to maintain the quality, then either you can't keep up with the rents because people don't want to pay as much. They don't want to pay more for a product that's getting worse and worse. Or in the worst case scenario, you've let it go to heck and you've got bad management, you're not putting capital in, and then rents can actually decrease. And so what happens then now becomes potentially a value add opportunity. So now somebody else can come in and buy it and fix it and bring it back to that standard, whatever that was originally envisioned when it was built, was originally executed, get new ownership in there, have better management, capital into it, change out the carpet, maybe do a new kitchen, a new bath, something that makes it very attractive and push rents and put it into the higher return. But then it gets to a point where it's stabilized, it's at the market, it's performing very well. Then another buyer can come in, and now they're buying steady, predictable cash flows. And they could be a buyer that just can hold this for 20 years and have those steady, predictable cash flows. Or they could be another one of those buyers that are short-term thinkers that are just going to let it deteriorate. And then you get another opportunity to buy it, value add back. So there's one company I've worked with that bought an asset 3 times over the course of 20 years. Same asset, same situation every time, had it running great, sold it to somebody. It went downhill. They bought it, fixed it, running great, sold to somebody, and then bought it again. Crazy story, but they were able to make money in the same asset. A value add, typically you expect returns 12 to 15, 16% annualized returns. They did that multiple times on the same asset. So there's a case to be made for taking assets and marking them up, or not marking them up, but taking existing assets and putting it in. But if you've got the same management team and they're telling you it's a value add opportunity, you got to ask a lot of questions, because why is it a value add opportunity? You've been running it all this time. Why didn't you fix it before?
Thanks for joining us for part 2 of our conversation with Rob Woomer from Skyway Capital Markets. We've uncovered the ins and outs of investment strategies, the importance of understanding risk, and how to make the most of value add opportunities. In the final part, next week, we'll dive into the current trends in different asset classes, why certain sectors are gaining traction, and how to identify the best opportunities in today's market. Again, thanks for listening, and make sure to tune in for part 3. Thanks for listening in to Wealth Beyond the White Coat, where time and attention mean a lot to us. If you found value in today's episode, please consider leaving us a review on your favorite podcast platform and share it with your colleagues and friends. Your feedback helps us grow and reach more professionals like you striving for financial freedom. Until next time, keep pushing the boundaries of your financial health. Thank you for joining us on this journey to wealth beyond the white coat.